Hello, I'm Graeme Bibby, Chief Investment Officer, joined today with Matt Leong, Portfolio Manager. We're here to give you an update on the quarterly macro environment for September 2025. So, starting with the overall economic fundamentals, it's useful to look at what's driving markets in the economy. So one of the things that we look at are liquidity measures, or one of them is money supply. We look at the US money supply, and you would have seen during COVID that a lot of money was pushed into the economy. It sort of came back out again. There was a bit of a slowing, and actually it went negative here. So there was a feeling of almost recession, and in some sectors there was a bit of a rolling recession, but now we've seen the money supply come back and it's actually positive. So we think that's one of the factors driving markets. On the next chart, we'll show you something else, which is actually a combination of services in the economy and manufacturing in the global economy and in Australia. This is a bit of a guide to what's coming in the economy. So this is a survey of businesses, and it looks at small, medium, large size businesses, and it's been picking up. So in recent times it's actually accelerated in Australia, which is really interesting. So despite some of the doom and gloom, actually there's some signs of growth after a period of what appeared to be weaker economic growth. So over to Matt for the market fundamentals on equities. What are your views on the equities at the moment? What have we seen?
Yeah, thanks, Graeme. So markets have rallied pretty strongly, but that has been supported by earnings growth, which we'll show you in the next chart. So this is the earnings growth expectations for the MSCI World, which is a global index, for 2025 in the blue line and 2026 in the orange line. And we can see here that in sort of the earlier part of the year, going into Liberation Day, we had earnings moderate and then fall off after Liberation Day, but has subsequently stabilized. And post the second quarter earnings period, earnings revisions have been quite strong, and we've seen that grow pretty strongly. So as a result, we do have a more positive view on the market. Even though the market has rallied, earnings have driven that rally, and we see valuations as largely supported by earnings growth. Another theme that we've seen more recently over the last few years is AI driving earnings growth. We still think that is relevant. However, fiscal policy going into next year will be very supportive of broader earnings growth across various industries, and we expect the market to actually broaden out in terms of returns into other industries. We've started to see a little bit of that so far, but we expect that to continue. Apart from equity markets, bond markets have also rallied, Graeme, and what's your views on that?
So we've seen things that have been quite volatile in the bond market, so particularly government bonds. Some of this was due to ebbs and flows of sentiment around would there be a recession coming, would there be sort of further sticky interest rates higher and inflation higher. But in recent times we've seen a bit of a drop here, and this is really sort of all about what's happening in the rate cut environment. So the central banks globally have had a coordinated cutting cycle, so that's actually quite positive for the economy and markets, and the long end or 10-year bonds are anticipating that as well, also anticipating that inflation is going to be reasonably under control. May rise a little bit, but net we're expecting a couple of interest rate cuts over the next year in Australia, and in the US they're front loading a lot of expectations, up to 6 cuts from relatively tight conditions. So these are all tailwinds for the economy and markets, and for credit spreads as well, which remain reasonably tight, and we think will stay reasonably tight.
Yeah, and overall for our positioning in our portfolios, we did turn neutral in the second quarter as per our previous update. We are believing that the outlook is incrementally more positive now, given what we've just spoken about, and we would look to take advantage of any seasonally weak periods in the market. September is usually a more volatile period, so that may throw up some opportunities, and we would look to add to risk in those times. However, if we don't get any weakness, which we might not given the fairly positive backdrop, we would be more than happy to let our equity allocations drift higher and go overweight through just market movement as a result. So that's our positioning. Graeme, anything else to add? Any closing notes?
Yeah, I think in terms of portfolio construction, it's always worth bearing in mind, how you have combinations of asset classes to, ride out bumps in markets and economies. And the role of alternatives in portfolios was particularly useful in the period that we went through in sort of April, May, as we had that sort of big tariff-oriented drop, and in the period of seasonally weak markets, which we could have in September and October this year. So the role of alternatives is pretty critical to that, and we build overall portfolios to be resilient, whether they're just public markets only or public and private market portfolios. So thank you for today, and if you've got any further questions, please contact your financial advisor. Thank you.